Hello, so we're going to look at what a bond is and the relationship that a bond has with interest rates. And this is a little bit complicated, so you have to bear with me. A bond, in essence, is a company borrowing money from investors to operate or to perform some tasks that they're wanting to do. So think of it from the government's point of view. So government wants to build roads, doesn't have enough money from taxes, so it issues bonds and it says, hey, we're willing to give people 2% per $100 for 10 years. So that means that you give the government $100, they give you back 2%, and in 10 years time, they give you back your $100. That in essence is what a bond is. And companies can also issue bonds. So let's say Bell is wanting to develop a new phone, and they can go to the investors and say, hey, we need, let's say, $100 million, but they sell it in increments of $100, and we're willing to pay, because the government is paying 2%, we can't pay the same as 2% because you'll pick a government bond, so we have to pay 3% or 3.5%. Let's say 4%. We have to pay 4% in order to get investors interested to want to lend us money. And that, in essence, is how bonds work. So the higher quality companies pay less, and the lower quality companies pay more. So you're rewarded for that risk of lending money to a lower quality company. So what about the relationship between bonds and interest rates? So they have an inverse relationship. That means when interest rates go up, bond prices come down. And when interest rates come down, bond prices go up. And to really understand this, it's really a mathematical issue. So think of it this way. If you had a bond, let's say it was a bond from Bell, a 10-year bond, so you give them $100 and they give you back $5 every single year, so a 5% coupon on that bond. And then in 6 months' time, you want to sell this bond. But the issue is that Bell have done new bonds, this time for 10%. So for new investors, they're going to give you 10% for every $100 that you give to them. So whereas you're getting 5%, they're now offering 10%. What do you have to do to be able to sell your bond? Well, you have to make it more attractive to people to want to buy it. So how do you do that? Well, you sell it for less than you paid for it. So instead of selling it for $100, which is what you paid for it, you now need to sell it for $90, and you take that $10 loss, because that's what you need to do in order to be able to sell your bond. And then you can go and you can buy another bond for 10% if that's what you wanted to do. But really, in order to be able to sell your bond, the important thing to note is that because interest rates went up and Bell is now paying a higher rate of interest, you have to sell your bond for lower in order to be able to sell it. Because nobody in their right mind is going to buy a bond for you for the same price at 5% when they can get exactly the same price bond for 10%. And it works the same the other way. Let's say you have a bond for 5% from Bell, and in the future they drop that down to 2%. How much more valuable is your bond? Now, if you want to sell your bond, you're not selling it for $100. Why would you sell it for $100 when nobody else can get a bond for 5% anymore? Since the new bonds that they're releasing are only 2%. So instead of the $100 that you paid for your bond, you now get to say, hey, I'll sell it to you for $110. And investors are willing to do it because they earn more on that interest. And that is the way a bond works. And it's important to know this because currently, with interest rates so low, it's very likely we'll see interest rates rise in the future. And as we've already learned, when interest rates rise, bond prices drop. Hopefully you learned a little bit about the way bonds work. I know it can kind of be a little bit complicated. But if you have any other questions, just send me an email and I'll do my best to answer them as best and as simply as I can.